Okay guys, next topic is short-term decision making. So here we will look at some of the decisions that we will face in exam. But before we look at decisions, we want to study something called relevant costs. Relevant means related. So these are costs related to a decision, or these are costs which should be considered when making a decision, or these are costs affected by our decision, whatever you want to call it. Relevant cost has three qualities. One is it is an actual cash flow. It is not notional cost. Notional cost are cost found by notion. Example of this is like the ABC costing we studied, the depreciation you studied in F3, the absorption costing. They are not actual costs, so they are notional costs, so they are not relevant in decision making. Another quality of relevant cost is they should be future cash flows. They should not be something that we have incurred in the past. They should be something that we will incur in the future. And third quality is they are not committed costs. Some costs, even though they will be incurred in the future, but we have already made a commitment for it, so they will not be relevant costs. So here are a few examples of relevant and irrelevant costs. Variable costs is relevant. You have already studied what is variable cost. It is cost that changes. Fixed cost is irrelevant, because fixed cost is cost that doesn't change. If it doesn't change, it would not be affected by our decision, so it would not be relevant. Fixed cost, if it is incremental, then it would be relevant. If it is cost that will be incurred additional, then it would be irrelevant. Or if it is cost that will be saved because of a decision, it will not be incurred because if we make a decision, then it would be relevant. If they say fixed cost irrelevant, if they give you details about it, then you have to see according to that situation and decide whether it is relevant or not. Sunk costs are irrelevant. Sunk costs, I've written definition here. Cost that has already been incurred is sunk cost. Opportunity cost is relevant. Opportunity cost is the benefit foregone from not utilizing an opportunity. The contribution foregone from using one option over another option. So sometimes there are decisions where we have to focus our attention from one project to another. So the contribution that we are taking from the project that we are foregoing, that would be opportunity cost. And then committed cost is irrelevant. Remember, committed cost is cost for which there is already an agreement made. Incremental costs are relevant. Incremental are variable. Incremental can be fixed as well. Variable are incremental anyway, but fixed costs can also be incremental. So if costs are incremental, whether they are fixed or whether they are variable, they are relevant. And then notional costs are not relevant. Remember I explained, like depreciation and absorption costing and stuff. Okay, so in F5 we look at the relevant cost of some of the main things that you face, the material, the labor, and machines. So let's look at, remember it uses the same principle that we had here. It should have these three qualities: actual, future, and not committed. But this flowchart will help it understand more easily the topic, because they are complicated a little bit. So relevant cost of material. If there is a decision and you want to know how much cost to include in that decision relating to the material, that would be relevant cost of material. So the first question we should ask ourselves is the material available in stock? If the answer is no, that means we have to purchase it. If we have to purchase it, then purchase or replacement cost would be the relevant cost. So if we don't have material, we have to buy the material, and whatever we pay will be the cost of that material. What if it is available in the stock? The next question we ask is it regularly used? If it is regularly used, if we use it in a project, then we have to purchase it again. So again, the purchase or replacement cost would be the answer. If we don't have it, purchase price. If we have it and we regularly use it, still the purchase price. The problem is when it is available and it is not regularly used, then we have to see, is there any alternative use? Can we use it instead of something else? Can it be used as a substitute product? If yes, we can use it in place of another material, then the relevant cost is the higher of scrap value and alternative use. If from alternative use, it can give us benefit of $1,000. From scrap value, it can give us benefit of $800. Obviously, we will use it alternatively. If there isn't any alternative use, then whatever is the scrap value. So available, regularly used, purchase price. Available, not available, purchase price. And if available, not regularly used, and there is no alternative use, scrap. If there is alternative use, then you decide whichever gives you a higher return. Relevant cost of labor. The first question we ask is labor available for the job? If no, whatever is the cost per hour, higher cost will be the relevant cost. If it is available, is there spare capacity? Is there extra hours available? If no, then if yes, there is no cost because we are already paying them. It costs us, labor costs us, but there is no extra cost in that decision that we are taking. If it is available, is there spare capacity? If there is no spare capacity, then we ask, is the overtime possible? Can they put in some extra hours? If the answer is yes, then overtime rate, because if they are doing extra hours, that would be called overtime rate. And remember, we charge that on our customers. And overtime premium, if you remember from your F2 studies, overtime premium on specific requests of customers is direct cost. If hours are not available and our customer tells us that, okay, I will pay extra, but do this job, then we can charge them extra. And if overtime is not possible, then we have to take employees from another job, and we will have a contribution there. It means that contribution will be gone, so we will charge the contribution that we are earning from that job and whatever the standard rate of pay is. Relevant cost of machine. We have to ask, is the machine available? If no, we have to hire it, so the higher cost, and whatever running cost. If there are any extra costs of running, that running cost should also be included. Is the machine available? Yes. Is there spare capacity? Yes. Then only the running cost. If it is available, running machine will cost power, petrol. Whatever is the running cost would be relevant cost. Is there any spare capacity available? No. Then it means that we have to take the machine from another job where we are earning contribution, so the contribution from that plus the running cost. Okay, now let's look at decisions that we are making. But before looking at that, let's look at examples of the relevant costs of material and stuff. Okay, let's see here. For example, suppose that a special job would require 50 hours of labor time. Employees are paid 10 per hour. There is sufficient idle time among workforce for 40 hours of work. The extra 10 hours would be worked in overtime, for which the additional pay is 12.50 per hour. So there is a job that requires 50 hours, and we pay our employees $10 per hour. There is sufficient idle capacity among the workforce for 40 hours. It means there is 40 hours extra available where there is no extra cost. And then because it requires 50 hours, we can do 10 hours overtime. So for the first 40 hours, the rate is going to be zero because there's no relevant cost. Even though we are paying our employees $10, but we are paying them anyway. For the 10 hours extra, there is going to be overtime rate 12.5, and that is going to be the relevant cost of labor here. Let's look at another example. Suppose that another special job would require 20 hours of skilled labor. The skilled workforce is paid 15 per hour and is working at full capacity. If the special job is undertaken, the skilled labor would be taken off other work that earns a contribution of 12 per hour after deducting the cost of labor and variable or his of 1.5 per hour. In this situation, the relevant cost of labor must include the variable cost of labor plus any associated overheads and the contribution that will be lost by taking the skilled workers off the work. Okay. We have 20 hours required, but we don't have capacity. It means we have to take it from another job, and we are paying our employees 15, and we are taking this from another job which earns $12 contribution. And remember, when we are diverting our employees from another job, then whatever contribution that is earned from other job, we will charge that on our customers. So the rate of employee is 15. So the hours are 20 and the rate of wage is 15. And we have opportunity costs, contribution foregone 12. And also there is overheads of 1.5 after deducting that. So it said after deducting. So multiplying by 15 will be the wage, and then the next will be opportunity cost. Adding it together, we have 540 relevant costs that we will charge. Next, an information technology consultancy firm has been asked to do an urgent job by a client for which a price of $2,500 has been offered. The job would require the following: 30 hours work from one member of staff who is paid on hourly basis at the rate of 20 per hour, but who would normally be employed on work for clients where the charge-out rate is 45 per hour. No other member of staff is able to do the member of staff in question's work. The use of 5 hours of mainframe computer time, which the firm normally charges out to external users at a rate of 50 per hour. Mainframe computer time is currently used 24 hours a day, 7 days a week. Supplies and incidental expenses of 200. Okay. First one, labor, it requires 30 hours. And we are paying hourly basis at 20, and they are normally employed on another job where we are charging 45. So it means there is no idle time and there is no overtime possible. So what we charge would be the cost of labor, which is 20 plus the contribution, which is 45 minus the charge out rate, 25. So when you add it together, it becomes that 45. But it is better to always do it like this. Always take your cost, labor cost and contribution, even though if it gives you exact answer. And the total hours is 30 hours. So per hour we are charging 45. Next, machine. We will be using a machine which the firm normally charges out to external user at 50 per hour. Mainframe computer time is currently used 24 hours a day, 7 days a week. So there is no extra time. So whatever is the charge rate per hour, that will be the relevant cost. Which is 250. And then supplies and incidental expenses, 200 is the total relevant cost. So adding all of these together, the relevant cost of labor, machine, expenses is 1800, and we are offering 2500. Is 700. So this is the profit. This is not actually the profit, but I will call it relevant profit. But we call it profit in decision making. Okay, now let's look at decisions that we are making. One of the decisions that we are making is make or buy decision. Make or buy decision are two types. One is make or buy decision with limiting factor or with scarce resource. Another is make or buy decision without limiting factor, without scarce resource. So sometimes there is a decision to make something within the organization or to buy it from an external supplier. Like many computer manufacturers are buying the processor, for example, from Intel, the 3D card, graphics card from NVIDIA. So this is make or buy. Make or buy is also outsourcing decision. So outsourcing is a general decision, and then make or buy decision is a specific type of decision in that outsourcing decision. Outsourcing can relate to anything, but make or buy decision specifically relates to products. So make or buy decision is also an outsourcing decision. So make or buy decision with limiting factor is when we have a situation where we are not able to do all the job, we are not able to produce all the products, so we must outsource some to the external suppliers, even if they are charging higher price, because we don't have sufficient capacity, we will not be able to do it ourselves. And make or buy decision without limiting factor is when we have enough capacity, but sometimes we want to outsource because we believe that if we buy it from the outside, it will cost us cheaper than making it inside. So the situations are different. In make or buy decision, even if externally with limiting factor, even if externally it costs expensive, we still will have to buy it. But in make or buy decision without limiting factor, if it costs expensive externally, we will not buy. So in make or buy decision with limiting factor, those products that cost less expensive outside, they will be outsourced. And those products that cost more expensive outside, they will be made. not per, we don't look at per unit, we look at per limiting factor, just like we looked at in throughput accounting. In throughput accounting, if you remember, we looked at contribution per limiting factor. Here we will look at incremental cost per limiting factor. But let's see. So this is a decision with scarce resource with limiting factor. So require advise MM. MM manufactures 3 components SAT using same machine for each. The budget for the next year calls for the production and assembly of 4,000 of each component. The variable production cost per unit of the final product is as follows. We have 3 hours, 2 hours, 4 hours, and then variable cost 20, 36, 24, and 20. Total becomes 100. Only 24,000 hours of machine time will be available during the year, and a subcontractor has quoted the following unit prices for supplying component S, A, and T. We currently have 24,000 hours available. They haven't asked, but let's see whether it is actually a limiting factor or not. So we want to make 4,000 units of each component, and the time that it requires is 3 to 4, and the total time is 36,000 hours, but the hours available are 24,000, so there is a deficiency of 12,000 hours. So for that 12,000 hours deficiency, we have to outsource some of the product outside. So outsourcing decision, we look at the cost of the supplier and we look at our cost. So our cost is 20, 36, 24. And then this assembly 20, it didn't say which one it relates to, so I will ignore it. And then the supplier has offered 29, 40, and 34. As you can see, all of them are expensive outside. If you look at it, this one is $9 expensive, this one is $4 expensive, and this one is $6 expensive. So those products that cost less expensive outside, we will give those priority. But we don't look at per unit, we look at per limiting factor. So the time taken is 3, 2, and 4. So dividing it by hours. This one cost highest outside per limiting factor, this one lowest, and then this one second. So there are 2 orders. One is outsourcing order and another is making order. Outsourcing order and making order is complete opposite of each other. So if we are making it, first we will make this one, second we will make this one. I think I've written wrong hours. This is 34 actually. Second we will make this one, and third we will make this one, because they cost expensive outside. If we are outsourcing, first we will outsource this one, second we will outsource this one, and third we will outsource this one. So what you make first, you outsource it last. So the production plan would be, first we will make product S, which is 4,000, and it takes 3, total becomes 12,000 hours. And then T is 4,000 units. But we have to see whether that limit is crossed or not. So this is 16,000. It means that if we add it together, that limit would be crossed. It is 28,000. So we only have 12,000 hours available. So what we will do it, we will take hours and divide by the time per unit. It will give us units. So the remaining will be bought. So if 3,000 is made, 1,000 will be bought, and whole 4,000 units of A would be bought. So this is make or buy decision with limiting factor, even though all of these products cost expensive outside, but we still have to buy a little bit of T and a little bit of, and whole of A, because we are not able to do it ourselves. We don't have capacity for it. Next, let's look at make or buy decision without limiting factor. Here, Shellfish Co. makes 4 components W, X, Y, Z, for which costs in the forthcoming year are expected to be as follows. Production 1,000, 2,000, 4,000, 3,000, and then marginal costs are given. Directly attributable fixed costs per annum and committed fixed cost. So fixed costs are given here, directly attributable fixed costs, 1,000, 5,000, 6,000, 8,000, and then there is committed cost. Directly attributable fixed costs are all items of cash expenditure that are incurred as direct consequence of making the product in-house. So if we are making product W in-house, we are incurring the 1,000 cost, but if we are not making it in-house, we are not spending $1,000. So these 4 costs directly attributable are relevant. This 30,000 committed is not relevant. A subcontractor has offered to supply units of WXYZ for 12, 21, 10, and 14 respectively. Should Shellfish make or buy the components? So here, if they are expensive, we will not buy them. If they are cheaper, we will buy them. We don't look at them per limiting factor. We look at per unit because we don't have any limiting factor. Okay, the cost of in-house without looking at the fixed cost. If we don't consider the fixed cost at all, we have 14, 17, 7, and 12. And then the supplier has offered 12, 21, 10, and 14. So without considering the fixed cost, here we are saving money and the other ones we are losing money. So we will only buy W from outside because it is cheaper, and every other product we will make inside. How much do we buy? The whole thing, because there is no limiting factor. Now let's look at the same thing, but including the fixed cost, because now the fixed costs are relevant. Fixed costs are given in total. What we can do is we can divide them into units. The units are 1,000, 2,000, 4,000, 3,000. So you can look at it in total or you could look at it per unit. First, let's look at it total. So total variable cost So usually we look at per unit cost like here, but because now fixed cost is involved, we will look at the total cost. 1,000, 5,000, 6,000, 8,000. So the total cost is 15,000, 39,000, 34,000, and 44,000 of making in-house. But if we buy from a supplier, taking that multiplied by the price of supplier to make it easier will be the total cost of supplier. So here, actually this is in-house. And then the suppliers multiplying by units. So we are saving about 3,000 here, about 2,000 here. So now we buy both W and Z when we look at the fixed cost as well. If we find per unit, I will delete this part. Because I've already calculated the total, what I will do is I will just divide this by units. So this will be the cost of in-house. So nothing extra needed. So the total cost divided by total units. It will give us 15, 19, 8, and 14, including the fixed cost as well. And the external supplier has offered 12, 21, 10, 14. So the decision is the same, whether you look at it per unit or whether you look at it total. Just to explain, if I take this 3 and multiply by total units, which is 1,000 at the top, it will give me that same saving. Okay, they are same. So this is make or buy decision with limiting factor and without limiting factor. Next decision we have here is further processing decision. There is another decision as well. Look at it if it is in book, outsourcing decision. Outsourcing decision is done in the same way as make or buy decision. There will be a whole department sometimes that we want to outsource. So we look at the cost that we are incurring and the cost of the supplier. That would be how we make a decision. Here we have products, and there it could be a whole department, for example. So the criteria, the way it is done, is exact same thing. Okay, next we have further processing decision. Further processing decision is a decision when you have a product and you want to decide whether you want to sell that product as it is or you want to further process it into something else and then sell that product. There are two factors we look at. One is the financial, another is the non-financial. In make or buy decision as well, we have the financial and non-financial factors. Like the financial factor is if the supplier costs more, then we will make it inside. If supplier costs cheaper, we'll buy it outside. The non-financial part is how does it affect our customers? Do our customer like our products? Is our supplier reliable or not? So those are the non-financial factors. In further processing decision, we also have financial factors and non-financial factors. The financial factors are if we further process it, how much is the extra revenue that we will earn and how much is the extra cost that we will be incurring. If the revenue is more than the cost, we will further process it. If revenue is less than the cost, we will not further process it and we will sell it as it is. The non-financial factor is whether our customers like the further processed product or not. Is there any demand for the further processed product or not? Or if we further process the product, it means that we don't have the original product. How does that affect our customers? Okay, let's see. Poison Chemical Company produces two joint products, Elish and Potom, from the same process. Joint processing cost of 150,000 are incurred up to split of point 100,000 units of Elish and 50,000 units of Potom are produced. The selling prices at the split of point are 1.25 per unit for Elish and 2 per unit for Potom. The units of Elish could be processed further to produce 60,000 units of new chemical LH plus, but at an extra fixed cost of 20,000 and variable cost of 30 cents per unit. Remember, fixed cost is usually not relevant, but here there will be extra cost incurred, so that is relevant. The selling price of LH plus would be 3.25 per unit should the company sell LH or LH plus. So the situation is that we have a process where we are incurring 150,000 cost, and then there are two products made, LH and LH plus. LH is 100,000 units, bottom is 50,000 units. LH can be further processed to make LH plus, and we have to see whether further processing has benefit or not. But before we look at that, remember, as a reminder, you say these in F2, so I will explain these again. Remember, we have joint or main or common products. These are two or more products produced from a common process. Joint or main or common process is a process where two or more products are made. And then joint, main, or common cost are the cost incurred in a common process. Okay, let's look at the situation here. So we have LH and LH plus made 100,000 units of these, 50,000 units of these, and they are sold for 2, and they are sold for 1.25 if they are not further processed. Okay, we could further process them, and they will be able to be made to make 60,000 units, because some of them will be maybe wasted, or maybe the LH plus are bigger units. So 100,000 units will give us 60,000 units only. But there will be an extra fixed cost of 20,000 and variable cost of 30 cents extra. The selling price of LH plus would be 3.25 per unit should the company sell LH or LH plus. Remember, if we are further processing, the 150,000 cost that we have already incurred is not relevant, because it is incurred anyway if we further process it or not, so it is not relevant here. So what is relevant is anything extra that we are incurring here. So let's look at the extra revenue and the extra cost. Okay, if we sell LH as it is, we will be able to have a revenue of 125,000. But if we make LH plus, which will be 60,000 units, we will be able to sell it at 3.25. It means our revenue would be 195,000. So there is an incremental benefit of 70,000. But there is extra cost as well incurred. One is the fixed cost that we will be incurring. Another is 30 cents per unit of input. Remember, input are 100,000 units, output are 60,000 units. So 30 multiplied by units of input. So we have incremental costs of 50,000. So when we look at the incremental benefits minus the incremental cost, we have a net benefit of 20,000. So the financial decision will be to further process it. Obviously, we have to look at the non-financial factors as well, which I explained. So this is decision-making chapter done.